Good morning, everyone. Today we're tackling two of the most exciting concepts in finance, return and risk. And yes, I did just use the words exciting and finance in the same sentence.
Exciting? Are you sure we're talking about the same subject? Finance sounds like it's all about spreadsheets and numbers.
Oh, it's much more than that. Think of return and risk as the Batman and Robin of portfolio management. They might not be swinging from rooftops, but they sure do save the day for investors.
Okay, so how does this dynamic duo work?
Let's start with return. In finance, return is the gain or loss made on an investment. Picture it like this. If you buy a comic book for $10 and sell it later for $20, your return is $10. Simple, right?
Got it. So return is like my comic book flipping for profit. But what about risk?
Risk is the chance that your investment might not turn out as well as you hoped. It's the possibility of your comic book collection getting accidentally soaked in soda. Very tragic.
Okay, I see. But how are these measured?
Great question. Let's break it down. Draws a simple graph. Historically, return is measured as the percentage change in the value of an investment. If you start with $100 and end up with $120, your return is 20%. Hence it is just ratio value, the absolute return, and the buying price. It is difficult to predict the return, but in portfolio management, we used to compute its expectation using the average return over some period that we call time series.
Makes sense. What about risk?
Risk is usually measured by how much the returns deviate from their average. We use something called standard deviation for this. A high standard deviation means more variability, like if your comic book prices bounce around unpredictably. A low standard deviation means they're more stable.
So, a higher standard deviation is like a roller coaster ride for my investments?
Exactly. You might have thrilling highs and scary lows. A lower standard deviation is more like a calm, predictable journey. Think of a leisurely train ride.
And how did these concepts come about?
Yes, historical context. The concept of return has been around for centuries. Early traders used it to measure their profits. Risk, however, got a modern makeover with the development of portfolio theory in the 1950s by Harry Markowitz. He introduced the idea that diversification can help manage risk, which is still fundamental today.
So, diversifying investments is like assembling a superhero team with different skills to handle various threats?
Exactly. By having a mix of assets, you reduce the impact of any single investment's poor performance. It's like having Batman, Superman, and Wonder Woman all working together.
So, to sum up, return is what you gain from your investments, risk is the chance of losing, and by diversifying, you manage that risk like a team of superheroes?
Perfectly summed up. And remember, while the stakes in finance might not be saving the world, managing return and risk is crucial for financial health.
And if my investments ever get too risky, I'll just call in the finance superhero team.
Well said. And that's a wrap for today. Keep those superhero strategies in mind, and you'll be managing your portfolio like a pro. Goodbye, and see you for the next lecture.